So this is the second part of our lecture for chapter number 4, stockholders equity. So now we're going to discuss here in this lecture about preferred stock. So what are preferred stock? Like I said, it has a preference for dividend, means that if a corporation has two kinds of stocks, common stock and preferred stock, and a corporation wants to give dividends to its shareholders, the corporation has to give the dividend first to the preferred dividend or preferred stockholders, and if anything left over will go to the common stockholder. That's the one major big huge difference between preferred and common. So entitled to a dividend before common stockholders if cumulative. So what is cumulative? So preferred stocks comes in two flavor: cumulative and non-cumulative. So what is the difference? Cumulative means that if you didn't pay me the dividend last year, you will have to pay me this year, and you are paying this year. You first have to pay me the last year dividend, and then you will pay me this year dividend. And if anything left over will go to common stockholder. Non-cumulative means if the shareholder didn't get last year dividend, they lost that dividend, and you only have to pay this year dividend. So cumulative means is accumulating if you didn't pay them. Non-cumulative means it does not accumulate. Dividends in arrears. This is the word is used for cumulative. So for example, if you are a cumulative preferred stockholder and you didn't receive the last 5 years of dividends, so those dividends would be considered dividend in arrears. Okay. Asset distribution preference. Once if you are distributing any kind of asset, would also go to the preferred stockholders during liquidation. Means you sold all your assets, you paid off all your liabilities, whatever left over first go to the preferred stockholders, and then it goes to the common stockholder. Other potential features: convertible into common stock. Not all preferred stock not all preferred shareholders are convertible. Some are convertible, some are non-convertible. They participate in the special dividends. Their dividends are usually 6%, and the price, normal price or the face value of a preferred stock is $100. So that could be this is the preferred dividend, that you are purchasing a preferred share at $100, you would get 6%, means every year you're gonna get $6 as a preferred dividend. Callable simply means the corporation can call back. Callback simply means, hey, preferred stockholders, I would like to buy back your shares, and the preferred people has to sell back these to corporations. So that's basically the preferred stocks in a nutshell. The next thing we're going to talk about is a stock split. A stock split is basically a forward stock split increases the number of outstanding shares and proportionally reduce the prices of the stock. For example, right now, suppose Google has 1,000 shares outstanding and they are selling for $100 a piece. So what they are going to do, they're going to say, we're going to split these shares into two. So now you have 2,000 shares of Google. However, their price will become $50. So a stock split is good. It increases the number of shares you have, but it also decreases by the same amount at their price. So the $100 share becomes $50. So the total equity remains the same. So if you multiply 1,000 by 100 is 100,000, and 2,000 by 50 is 100,000. So overall, no effect, but the number of shares grew. So it's like, say, no stockholder equity accounts are changed because unchangeable. For example, Savannah Corporation issue a 2-for-1 stock splits on its 2,000 outstanding $1 par. So what's going to happen? They will become $4,000 4,000 outstanding. Will have dollar sign is wrong. 4 outstanding shares, and their par value will become 50 cents instead of $1. So 2,000 shares become 1,000, and $1 par value becomes 50 cents. So that's our stock split. Our reverse stock split increases the company par value and reduces the ordinary share. So you can go back to the same example. In this example, we were talking about forward split. Here is a reverse split. So you have over here in this, you have 2,000 shares, right? So you convert these 2,000 shares into 1,000 shares because you are reverse splitting it, and their par value from $1 will become $2 par value. That's the reverse split. Treasury stock, as we discussed previously, are shares of stock that corporation owns, is that is acquired for purpose other than retiring them. So for example, a treasury stock is purchased, a stock is purchased and keep in the treasury, so we can give them as a dividend, we can give them as a bonus, or we can simply maybe in the past year or past month or past quarter we sell for at a high price. Now they are selling it cheaper, so we buy back. That will increase the price of the share in the market. Also, they like to keep more shares in hand, so there is no hostile takeover. So these are the reason people do that. So here is a journal entry, an example. So for example, Pitzer Corporation acquires 200 shares of its stock for $15 share. To record, so what they're doing, this $15 multiplied by 200 is equal to $3,000. So they are purchasing, so the stock is coming back into the company and the cash is going out of the company. Later resells 100 of these shares. So what they are, the $2,000 is coming in because they are selling for $20, and the 1,500 treasury stocks is going down, and the paid-in capital, because you receive extra money, so that will be considered paid-in capital for treasury stock. Just like when you are selling, it will become additional paid-in capital. This time you are selling the treasury stock, so it's a paid-in capital, belongs to treasury stock. Treasury stock is reported as a reduction of equity on the balance sheet. That's why in the previous example, I put it on the debit side. So the treasury stocks and dividends reduces your equity. Common stock, preferred stock, retained earnings, additional paid-in capital increases your equity. Okay. Now we're going to talk about cash dividends. Dividend represent a distribution of asset or shares of stock from corporation to its shareholder. Cash is the most common form of dividend, but asset also gets distributed as a car, a computer, a piece of land. So remember one thing, okay, we'll talk about it a little later. Dividends are not required to be paid by a corporation. So corporations are not obligated to pay dividends to their shareholders, and shareholders cannot take corporation to the court because the corporation is not paying dividend. For example, we studied in notes payable and bonds that interest payment is supposed to be paid as promised monthly, quarterly, or yearly basis, but dividends are not required. However, once the board of directors make an announcement that we are going to pay a dividend, then the dividend becomes a liability for a corporation to pay. Okay. So however, they become a liability once they are declared, and they are always declared by board of directors. The CEO and the CFO cannot declare it. And once they declare the cash dividend for $1,000 and cash for $1,000. Dividends are not considered expense. They are not expense. They do not go to the income statement, do not appear on the income statement. Instead, they are direct reduction of retained earnings. This is a very important point. Make sure you remember this. Then there is a stock dividend in which you give them more stocks. Dividend may also take the form of stock distribution. While the recipient of stock dividend does not receive additional shares of the stock, so receive additional shares of stock, their proportionate ownership in the corporation. So for example, if you're receiving 10%, so it will increase 10%, 20%, increase it 24%. wealth does not change. Stock dividends are accounted as a transfer of portion of retained earnings to the paid-in capital. Therefore, stockholders' equity remains unchanged. So basically what you do, you just say debit a stock dividend and you debit retained earnings and you credit a stock dividend. That's all you have to do. Accounting for share retirement. Retired shares are classified as unissued unauthorized shares. So retired shares goes back into the unissued authorized shares. So make sure you know this. Additional paid-in capital related to retired share is removed from the balance sheet. The sum of the par value and the average additional paid represents the original issue proceeds. If the repurchase price is less than the original proceed, credit the difference to the additional paid-in capital. And if the repurchase price is greater than the original proceed, debit the difference to additional paid-in capital. So you only deal with the increase or decrease of the additional paid-in capital. Accounting. A company can hold or retire repurchase shares. Treasury shares are a corporation-owned stock that are authorized, issued, and previously outstanding, and that the corporation buys back. Shares are still considered issued shares. Remember, treasury shares do not receive dividends. Retired shares are similar except that these shares are no longer considered issued, right? So this we'll talk a little bit later in this. Okay. Purpose of share repurchase. Why companies buy back shares? For stock option plans, because they promise stock bonus plans, employee stock purchase plan. They usually give them. For exchange for another firm's voting share in the merger or acquisition. You may have heard one company is buying another company. Half of the proceeds going to the company is in cash and the other half is going, for example, in the stocks. To support the market price of the stock, so we buying back, so it increases the demand and the stock price goes up. To prevent takeover attempts, and I would put a word, hostile takeovers. To distribute cash to shareholders without formally increasing the cash. As we talked about, if you give them a cash in the name of dividend, they have to pay a tax which is higher. But if you buy back the shares, they have only what we call capital gains, and capital gains tax could be as low as 15% for some people. But the dividend income, when you put in the income, it could be as high as 28 to 35%. All right. Now, accounting for treasury stocks. Firms typically record treasury stocks in contra stockholders' equity account, basically on the debit side. They are the reduction of total stockholders' equity on the balance sheet, reduces the number of shares outstanding, don't have voting rights, cannot receive cash dividend. A split and can receive a stock dividend in some states. Not always, but most likely not. Two methods of accounting treasury stock, the cost method and the par value method. You do it, a cost method, you only doing at cost, and the par value is the par value of the repurchase. Cost means the share you're selling for. Accounting for preferred stock has two common preference over common stock, priority over receiving dividends, and right to claim. So these are the two priorities we already discussed. Most preferred stock is non-voting. If you receive a question in the exam, which one has a voting right, always select common stock. Majority, 99.99% preferred stock, 99.99% preferred stock has no voting rights. Okay. Our dividend preference means the firm must pay preferred shareholders before common stockholders. So we're going to stop over here and we're going to do the third and the last video after this one.